Good afternoon, everyone. My name is Laura Ryan, and I'd like to welcome you to today's webinar. I'm joined by Ed Redder, who will be leading the presentation of the material that we have for you today. Today, we'll be covering topics and issues impacting retirement plans. This webinar is the third in a series of 4 presented each Thursday at noon in September. Our next and last webinar in the series will focus on ERISA litigation, lessons learned and best practices for fiduciaries. During the webinar, please feel free to use the question panel at the upper right-hand corner of your screen to submit questions. We will answer questions at the end as time allows, and any questions that we don't answer during our time together today will be responded to via email after the webinar. After today's session, you will receive in an email a very brief survey regarding the webinar. This survey will only take a few minutes to complete, and we would appreciate your feedback on the presentation. With that, I'll turn it over to Ed.
Laura, thanks for the introduction. It's a pleasure to be with everyone attending online here today. As Laura mentioned, my name is Ed Redder. I'm a partner in the Thompson Hine Employee Benefit and Executive Compensation Practice Group and work primarily out of our Columbus, Ohio office. Each year it seems that the retirement plan space brings new challenges and opportunities, and certainly this year is no exception to that general rule. During today's presentation, we'll touch on a number of those developments, opportunities, and challenges and share our thoughts with the group on the phone. With that, let's move directly into the presentation. So today, again, we're going to start off with a discussion of general retirement plans update that'll cover kind of what's going on, what's happening, what may be coming down the road, current issues affecting defined benefit and defined contribution plans, move into a couple of defined benefit plan hot topics that are specific to defined benefit plans, likewise with 401k plan hot topics, touch on the latest 401k and 403b plan related litigation. We won't spend a lot of time on that area because it is the topic of a future call as well next Thursday afternoon. And then last but not least, what I call and don't forget. These are topics, year-end reminders, other miscellaneous items that we wanted to make sure that folks don't forget about. So let's shift to our general retirement plans update. One of the more recent events that has occurred in the retirement plan space is the recent issuance of an executive order on August 31st, which calls for guidance in 3 broad areas. First, expanding access to open MEPs and other retirement plan options for non-traditional employers. Second, improving the effectiveness of required disclosures while reducing the burden on employers. And then third, updating required minimum distribution tables for mortality changes. And I want to dive into each one of these just briefly and explain why we're here and what the guidance looks to be exploring. First, expanding access to open multiple employer pension or multiple employer plans. So let's just back up for a second and describe what we're talking about. A multiple employer plan is a retirement plan in which 2 or more unrelated employers participate. And when I say unrelated, what I really mean is 2 employees that are not in the same control group. So for purposes of the tax code, we don't treat those 2 employers as sufficiently affiliated to be considered a single employer for plan purposes. And when we talk about open multiple employer plans, we're talking about plans in which employers really have no other connection other than the fact that they're involved in the same retirement plan. And so why is it that there's this need for guidance in this area? Well, first is one related to a rule on the tax side of things. It's the one bad apple rule. And so in a multiple employer plan, clearly we have multiple employers participating. We could have a large number of employers participating, all unrelated, all have different levels of sophistication and ability to fulfill their obligations to the plan. And so it could be quite possible that one of those employers could have problems in their operational compliance with the qualification rules under the tax code. And the issue comes up if one does, and there's a potentially disqualifying event for that employer, it really does taint the entire plan and risk disqualification of the entire plan, which again would impact all of those other unrelated employers. So that's one area where it had a chilling effect on implementation of these so-called open maps. The second is really the Department of Labor's position on multiple employer plans. The Department of Labor really has taken the position that if you have employers that lack any sort of commonality of interest or affiliation beyond sponsoring or maintaining or being involved in a retirement plan together, that they are treated under ERISA as truly separate plans. And so the implications of that would be that each employer, even though they're in a single multiple employer plan, would have to file their own 5500. If they're sufficiently sized, they would have to have the audit performed. They'd have to fulfill their own bonding requirement and other ERISA-related items. And the issue with that is that it really eliminates or reduces the cost benefit of being in a multiple employer plan. And so what did this guidance direct? Well, the president directed the IRS to review the one bad apple rule for possible exceptions or amendments to that rule to address the concern. And then second, it directed the Department of Labor to review the rules regarding the necessity of affiliation between employers. And we do think there will be some development on this, certainly some development on this in the future, because we've seen kind of a similar iteration earlier this year with association health plans. There was early guidance in January of 2018, followed by the final regulations that were published this summer. So we do expect there to be some development there, and so those rules truly seem to be geared to expand the access for employers to these open multiple employer plans. So that's topic one. The second topic is the effectiveness and reduction of cost of required notices, which really has probably broader application and appeal to folks on this call. We all wrestle with all of the disclosure requirements that apply to retirement plans, how cumbersome they are, the delivery obligations that employers have, with the recognition that almost no one reads the disclosures. So we have this issue of the complexity of the disclosures and the fact that they really are not achieving the purpose that they're designed to achieve. And so the president directed the Department of Labor, in consultation with Treasury, to complete a review of making disclosures more understandable while reducing the cost of production. And I think of particular note is that the executive order specifically called out and directed the agencies to consider the broader use of electronic disclosure. I mean, if we all step back and think about it, I can't swing a stick out on the street without hitting somebody that's looking down at their cell phone, right, or their iPhone or some other device. That the reality of today is most folks consume data electronically and have mobile devices and other electronic devices. So that is I think would be a positive development and one we'll closely watch. Finally, we have adjustments to the life expectancy and distribution period tables for required minimum distributions. So those distributions are geared or based on life expectancy. But the current rules were formulated back in 2002 based on mortality at that time. And so we now fast forward to 2018, and there's a recognition, or at least an expectation, that we've had mortality improvements over time. People are living longer, and so by adjusting the mortality tables, we could actually stretch out payments over a longer period of time. Now, in reality, what's the improvement? Maybe a year and a half, 2 years max. So I don't know if it'll have a dramatic impact, but it is an area that they are looking at developing and possibly updating the mortality tables. The other piece of that is they're considering whether they ought to put in place a requirement to regularly update the mortality table. So there would be periodic updates. So those are, at a high level, the three areas that the executive order examined. But not to be outdone, and not in the absence of other efforts, we do have congressional efforts in the retirement plan space as well. And I'm not going to dig into this a whole lot. The primary point I want to make here is that Congress is busy. They are involved and interested in a variety of retirement plan changes. I've listed several of the bills that have been introduced in 2018, including RISA, which has been around for quite some time and has been reintroduced this year, the Small Business Employees Retirement Enhancement Act and the Retirement Flexibility Act. The most recent, though, is what's been dubbed Tax Reform 2.0, which includes the Family Savings Act of 2018. Now, this was just introduced, a couple weeks ago, less than a couple weeks ago, on September 10th of 2018. Now, I've listed a number of notable areas that the bill would touch on. There are other areas, but just very quickly, again, similar to the executive order, this bill would provide some multiple employer plan relief for what are called pooled provider plans. There's a little, it's not quite as uncertain and nebulous as the executive order, obviously, and so there's a lot more detail here. And so for plans or for employers that have no other affiliation other than sponsoring a retirement plan, there would be some relief if they are involved with one of these pooled provider plans, where the pooled provider would acknowledge fiduciary status, acknowledge status as a plan administrator, acknowledge certain of the administrative roles for the plan, and register with the regulators as well. And so there would be certain relief from the one bad apple rule that we already discussed, as well as some relief from being treated as multiple plans under ERISA. So just that's very quick run through that. One of the other areas is 401k safe harbor enhancements. So the proposal looks to streamline and provide additional flexibility for 401k plans using non-elective safe harbors. And so it would eliminate the non-elective safe harbor notice requirement, allow an employer to elect to utilize a non-elective safe harbor up to 30 days before the end of the plan year, or if it's after that date, and as long as the employer would provide a 4% non-elective safe harbor contribution, would allow them to essentially adopt this retroactively up until the last day of the following plan year. So that would dramatically improve the flexibility that's offered for 401k safe harbor plans. Again, non-discrimination relief for closed or frozen DB plans. We have seen relief over the years on issues dealing with benefits, rights, and features testing, accruals, and minimum participation requirements that are issues that are faced by closed and frozen DB plans. So another area to watch closely. And then finally, a study to examine PBGC premium levels and structures. And so again, I want to underscore that this is not an exhaustive list, but it does give a flavor that Congress is active in this area, and there are a number of areas where there seems to be traction on a bipartisan basis. Next, let's talk a little bit about a rule that we've struggled with for the past 2 years and are no longer struggling with, and that is the final fiduciary rule, as we call it. So if you remember back, this rule was adopted back in April of 2016, had a delayed applicability date into 17. There was a whole host of relief offered by the new administration for the rule and for compliance with certain of the prohibited transaction exemptions. Earlier this year in March, the Fifth Circuit issued a decision vacating the rule. Now, we were kind of wringing our hands for a while between that date and when it was officially vacated on June 21st, but we did get the official notice that it had been vacated effective June 21st, 2018. And so what does this mean? Well, it means that the previous guidance springs back into place. So we have the old or the historic five-prong rule for determining when an individual is providing investment advice that would make them a fiduciary under Section 321 of ERISA. But we don't only have that. We also have the other guidance and related guidance that has applied before. One specific item is Advisory Opinion 2005-23A, which really addressed or one of the issues it addressed was the status of an individual or a service provider providing advice on distributions and rollovers. And so with the vacation, we do go back to the old guidance. I think it's also important to remember that it was not only the fiduciary rule that was vacated, but all the related prohibited transaction exemptions that were added or modified with the final rule. And so one significant piece of the rule, or in tandem with the rule, was the best interest contract exemption. A number of providers have changed, altered their practices, their procedures over the years to attempt to comply with the final rule or to utilize the relief provided by the best interest contract exemption. And now that guidance no longer applies. Now, I will say there is limited non-enforcement policy that we've identified here, Field Assistance Bulletin 2018-02, which provided some relief to service providers that changed their positions and would have to have quickly changed their positions because they can no longer rely on the best interest contract exemption. And so there is limited relief there. But again, we go back to the old guidance. And so what is a plan sponsor or administrator to do, or fiduciary to do, when they're evaluating the implications of the change? Well, again, various service providers altered their behavior, altered their practices, and enhanced their fiduciary advice services subject to enhanced protection. So let's say, for instance, service providers decided to or continue to advise on rollover decisions from plans. Well, under the final fiduciary rule, that advice would have been considered investment advice and had to then comply with either be non-conflicted or comply with prohibited transaction exemptions, and one that was relied upon heavily was the best interest contract exemption. We fast forward now, and we have certain enhanced advice services still in plan, but now they're no longer fiduciary in nature. It's no longer considered investment advice. And so there is some confusion, I think, still out in the market as to what sponsors ought to do about that. And I would say plan sponsors and fiduciaries really ought to evaluate their current service structures, make sure they understand the interactions that are going on between plan participants and their service providers, and also make sure that they're comfortable with the protections that are in place to avoid, to the extent possible, conflicted advice in these areas. And last I would say on this slide is, beware of service creep. It has been very common in the industry for providers, retirement plan record keepers, and other providers to try to introduce new and additional services that may be non-germane or outside of the ordinary scope of retirement plan services. Fiduciaries need to be aware and evaluate those additional services to make sure they're comfortable that they are either within the normal service provisions of their contract, and that they understand the implications of those additional services. So while we don't have the final fiduciary rule now, we do have the issue of dealing with the consequences of its elimination. And so again, plan sponsors and fiduciaries are wise to pay attention to those issues and developments. I'd like to move on to another hot topic today, and that is one, and again, it's one that affects both 401k plans and defined benefit pension plans, and that is the issue of missing participants. So again, this is not a new development. We've been wrestling with and dealing with missing participants for years and years and years. One common area that has come up in the past has been with terminating plans. What do we do if we can't find our participants so that they can receive distribution of their benefit or plan account? And we do have guidance that has been issued by the PBGC, the IRS, and the Department of Labor dealing with missing participants in terminating plans. However, there have been some recent developments that have brought this to the forefront for active plans. And one started as a DOL enforcement initiative that started in the Philadelphia office back in 2016. So the Department of Labor started reviewing Form 5500s to identify employers that had a large number of terminated vested participants that were not receiving benefits. So they interacted with the employer, they engaged in a dialogue. They understood from that dialogue that these were folks a lot of these folks were missing participants, or the plan sponsor at least claimed, or plan administrator claimed that they were missing participants. The DOL then started a campaign of sending out certified mail to the last known address of these so-called missing participants, and actually we were very successful in contacting and finding these folks and recovering assets that should have been paid to participants. So it really was an eye-opener, I think, for the Department of Labor, and it has caused them to focus on this issue significantly. I think the other development as well is in IRS audits. Auditors were identifying as a problem with the operation of the plan the fact that folks who had reached their required beginning date under the minimum required beginning date rules under 401A9 were not commencing benefits, and one of the explanations why is that these folks were missing participants and we couldn't. And so there was some concern and a lot of hand-wringing about this as well. Now, the IRS did issue a memo to its EP examiners last fall in October that did provide relief from disqualification based on the failure to commence RMDs if the plan administrator took reasonable steps to locate the individuals. And so what were these IRS steps? Well, one was to search the plan sponsor, and publicly available information for alternate contact information. Two was use a search method, either a commercial locator, credit reporting agency, or other proprietary internet search. Three was attempt contact via certified mail at the last known address, and any other alternative contact means. So if you have the email, you have a telephone number to reach out to those folks. And so if an administrator takes those steps, then the IRS will not challenge the qualification of the plan based on the failure to commence RMDs for missing participants. Now, that does leave kind of a hole in the guidance. So we do, again, and I've noted on the slide, the DOL guidance for terminating plans, which is similar to the guidance that I just mentioned from the IRS, but not identical. The DOL always seems to have this kind of catch-all at the end. Follow these steps, but again, depending on the facts and circumstances, prudence may dictate taking additional steps. So say you have a missing participant with a very, very large account balance. Is it prudent just to follow these kind of laid out steps and not take any further action, or would it be prudent to invest a little bit more to try to find and track down this person? And so but again, this is for terminating plans, and so we're left to wonder, what are the appropriate steps in ongoing plans? The other piece of guidance I'd like to mention is this PBGC final rule, which expands their missing participant program to terminating DC plans. And so under this program, you can be a transferring plan, which means that you would actually transfer assets to the PBGC, pay a per head fee to the PBGC related to these missing participants. And then the PBGC would take steps to try to reach out and find these folks over time, and then ultimately pay the benefit once they're found. Alternatively, the plan could be a notifying plan, where you really just contact the PBGC, let them know of the termination and of the financial institution that's holding these assets, and again, they would take steps over time to reach out to the missing participants and relay the information along to them. But so again, we are kind of in this we have this absence of guidance from the DOL on ongoing plans, but certainly we have some practical steps for plan administrators. There really are certain steps we ought to be taking as plan administrators to mitigate this issue, and then actions that we can take to try to contact and find these missing participants. And one is just, again, look at the plan. Let's determine when distributions are required. Remember, it could be required to commence at 65. Many plans have kind of a deemed election to defer until the required beginning date. But again, if you haven't looked at this provision and haven't confirmed this, it's probably wise to do so. Second, review your plan terms regarding missing participants and uncashed checks, and including forfeiture provisions. Again, just to brush up on what your plan says. Certainly talk to your service providers as well. I think a lot of the record keepers recognize this issue and are becoming more aware and taking steps to put in place some solutions on their end to help mitigate the issue. Certainly enhance your communication efforts to remind participants to update their contact information, right? We ought to have in the SPDs that it's their obligation to keep us up to speed, and reminders certainly will not hurt.
Yeah. And Ed, I would just add emphasis to the point you made about working closely with the record keepers for the plans. We have found that many of the record keepers are identifying and tracking people whose mail is being returned, or people that they can't locate when it comes time to make minimum required distributions. But the sponsor is not aware that this list is out there, is not regularly reviewing this list, is not sure what efforts are being made by the record keeper to locate participants, and what efforts the record keeper, expected the plan sponsor to take. We have found many surprises, including lists that contain large numbers of active employees. And, the first question is, how could we not know where an active employee is? And, discovering very simple fixes like, 2 address blocks in an HRIS system, and the wrong one was being fed to the record keeper. And as soon as we sort of flipped that switch, suddenly we were getting the right address and using the right address for communication. So I would really encourage folks to engage in those conversations. Another thing related to this topic is uncashed checks. Those too are sort of a form of missing participants, in the sense that we've sent a check, they've requested a distribution, or we've processed a de minimis distribution, but the checks are out there uncashed. And again, that is also something to inquire with the record keepers. And keep in mind, this isn't just about distributions and getting amounts paid to folks that are entitled to it. Yes, that is certainly important in one aspect of this, but if you don't have the correct addresses, you're not getting all of the required disclosures and notifications to these people either. You're not getting QDIA notices or, I mean, in the case of active employees, safe harbor notices and fee disclosure notices and all those things that the regulators want to know are getting delivered to participants.
No, thanks, Laura. Those are all great points, and I think the bottom line is while we don't have direct guidance from the Department of Labor on their stance, we do have a good idea. We have the IRS guidance. We also have the Department of Labor's guidance on terminating plans, and so I think it's an appropriate step to review your policies and processes on this issue and develop those if you haven't, and then certainly document your processes and efforts going forward. Because again, with current employees, we really ought to have that kind of warning sign up front if they're not receiving, if disclosures that we're obligated to make are coming back as undeliverable or return. That gives us an early chance to say we need to find those folks, which ought to be a relatively simple process. And then underscore to them the need to continue to update their records. So another issue that's come about, another hot button item, is the uptick in audit activity. So we're all aware of the changes to the determination letter program, which heavily restricts or reduces the opportunities for plans to seek a favorable determination letter for their plan from the IRS, really at initial creation and then on termination. Those are the general areas where we can seek determination letters. Well, while we've drastically reduced the burden of determination letter processing, we have employees and agents that are no longer tasked with reviewing those applications, and that has resulted in shifting of resources to audit activity. And I think Laura would echo this, but I've seen an uptick in audit activity recently, certainly over this summer, and I think it's a trend that will continue. And so I think it's always a good idea to at least talk about what the IRS is looking for. What are their top audit issues for, and specifically we address defined contribution plans here. One is the definition of compensation. Compensation is always a tricky part, not only how it's defined within the plan, but then how it's applied, how the employers are capturing that compensation and ensuring that their systems and payroll codes match up with the definition of compensation within the plan. So that's a common area for concern and issues. Testing is another. Again, non-discrimination testing relies on a lot of data and information from the plan, from the employer, from the plan sponsor. And so again, if operationally folks are not providing the data and it's not clean data, then even if the testing is done exactly right, we're going to get flawed results. So that's another potential area. Timeliness of amendments, again, that's a perennial issue. We need to be aware of our deadlines for amendments and make sure that they're executed properly. Use of forfeitures, again, this is another common issue that comes up year after year after year. Adoption of plan by participating employers. Again, we encounter plans occasionally that they have a variety of employers participating or not participating. Their employees are actually in the plan where they're not listed as a participating employer under the plan document, or they don't have a good sense of what employers are in their control group. And so that can obviously cause problems from a testing perspective and otherwise. Reconciling deductions and contributions. Again, we see mistakes on this commonly. And then consistency of plan document with administration. Again, with the trend of going to more pre-approved plans, plan documents have actually improved the consistency of and timeliness of amendments, and the terminology used within the plans has improved, but we still have issues with how the plan operates. Is it operating consistent with its terms? And so that's again a common problem that we see. On the DOL side, we continue to see issues and activity with timeliness of contributions and loan repayments. Again, this is similar to where I think the guidance on missing participants will end up, right? We have this open-ended guidance that doesn't really give us a definitive answer as to when contributions are timely or not. but that window has decreased and shrunk over time. And so it is very common to see some issues with the timeliness of contributions. Expenses, are your expenses reasonable? Have you reviewed your expenses over time? Alternative investments, another common issue. Forfeitures, are we using forfeitures properly? Uncashed checks, again, this is the issue that we've talked about with missing participants, so we won't hound on that. And then finally, participant disclosures. Are participants receiving disclosures that they're entitled to, and are those disclosures appropriate? And so what should we be doing? Again, and we recommend this all the time, plan sponsors should consider their own internal reviews. So it's much better and easier and more cost effective for you to identify potential issues and correct them ahead of time. And so use the correction programs. The IRS has done a fantastic job, I would say, over the years of enhancing the correction program, making submissions simpler. And in fact, earlier this year, the EFCRS fees, user fees were streamlined. It's a streamlined fee structure. We don't have a lot of the exception rates that had applied, special rules and special areas had different rates. But the good news is the maximum fee has been capped at $3,500 for a VCP submission. I believe the top in the past had been $15,000 or maybe even possibly north of that. So it's a good development for large plans. On the flip side, though, I have heard some grumbling by smaller plan sponsors who were negatively impacted by this. But again, for our audience, I think this is a positive development and truly recommend utilizing the correction programs when necessary.
Yes, I agree. I would, though, mention that while it's great that we have received a lot of very detailed guidance and information from the IRS through the EFCRS revenue procedure, I will caution that there's a lot of different types of errors, and there's a lot of different prescribed methods of correcting those errors. And be very cautious when you identify an error and make sure that you are following the IRS's guidance about how to correct. I very frequently, will hear from clients who are, just generally confused about what types of errors get corrected which ways, and even, confusion that, we missed applying a deferral election for a couple of pay periods. We'll just double up the person's contributions for the next couple of pay periods. That's not the way you correct, for example, missed deferral opportunity. You may actually be obligated, then this gets, pretty complicated. We won't go into detail, but the company may actually be obligated to make a contribution to make up for those missed deferrals. And the distinction between a missed deferral opportunity, where let's say you failed to apply a participant's deferral election at all, or another missed deferral opportunity is you failed to apply it to certain type of compensation that was paid during that pay period, pay under this pay code you applied it to, but not pay under this other pay code, even though it should have been applied to both pay codes. That's distinguished from the late deferrals that Ed was alluding to. That's the focus of the DOL, where you applied the deferrals, but you held on to the money too long. It got lost in, transmission and it was out there too long, where the correction there is making up lost earnings. The other thing I'll caution is generally there are no de minimis exceptions to correcting. Now, I say generally, there are a couple of very limited scope de minimis exceptions where you are permitted explicitly to not correct. But I also have clients call and say, well, it's just, a couple of dollars for, 10 or 12 people. Do I really need to, make a correction in that case? Isn't there a de minimis exception? And generally there isn't. And you should proceed in making even small corrections and corrective contributions in those cases.
No, Laura, that's great advice. And I would also underscore the fact that while we have the self-correction program in EPCRS, which means you can correct operational errors without a formal submission to the IRS, self-correction doesn't mean you correct it any way you like, to Laura's point. There are very clear examples and guidance within EPCRS within the program to tell you kind of the appropriate correction for different errors. And remember, if you go outside of those corrections and the IRS later comes in and disagrees, you don't have protection. You don't have the protection that you would have through the voluntary correction program, which would result in a compliance statement from the IRS. And I guess the other thing I would mention too on this slide as well, we've talked about EPCRS quite a bit. There are other correction programs. There's the delinquent filer program for delinquent 5500s. There's also the voluntary fiduciary correction program for certain fiduciary breaches as well. And so those are also helpful programs that we should all keep in mind. I'm going to touch on this one quickly. And the reason why I have a pendulum on this slide is that it seems that the guidance on this continues to go back and forth depending on the administration in office when the guidance is issued. And so this is on economically targeted investments. So funds chosen at least in part based on their environmental, social, or governance characteristics. So one might be a green fund, right? One that doesn't invest in firms that are involved in or tied to fossil fuels. That might be an example. So the general guidance has been that fiduciaries may not sacrifice investment returns or assume greater risks to promote collateral social policy benefits. And so again, the tone has changed over time, and we got our most recent guidance in April of 2018, which again reiterated that the primary consideration has to be the economic interest of the plan to provide retirement benefits, and that while ESG, again, environmental, social, or governance characteristics may be considered, fiduciaries should not too readily treat them as such. So what does that mean? So these ESG factors could, just beyond their collateral benefit as kind of a socially responsible benefit, also have some impact on the financial performance of the fund. And so while that's a consideration you should take, the DOL is warning, don't jump to that too quickly and rely on that. Another item addressed in the guidance is that an investment policy statement may, but it's not required to contain ESG-related guidelines. I think there was some confusion as a result of some past guidance that seemed to suggest that we had to include these within our IPS, but that is not required. I would also caution in the QDIA context, a qualified default investment alternative. Remember, this is the investment that we default our participants in if they don't make an affirmative election. The default nature of the investment really alters the analysis. And so we have some concerns as, if as a fiduciary we have a social agenda or outlook, it really could implicate the duty of loyalty if we make a decision based on those ESG factors. So just be cautious in that, and certainly review the guidance if you are considering investing in an economically targeted investment. Just very quickly, and I know we're about 15 minutes before the close, I want to just touch on a few hot topics in the defined benefit plan area and the 401k plan area. One is that pension de-risking continues. We have very good performance in equity investments continuing this year, which has obviously had a positive impact on the funding status of plans. At the same time, there's still a continued strong desire to reduce variable rate PBGC premiums, and so we are continuing to see a drive to de-risking. Another item, DB plan approved plan restatement period. So for our pre-approved DB plans, that window opened in, I believe, at the end of April of this year, and will remain open until April of 2020. And so I think this is important to note, because with the elimination or reduction in large part of the determination letter program, I think plan sponsors will be looking at and kicking the tires on pre-approved plans to see and consider whether their plans, their potentially individually designed plans, may fit on a pre-approved plan and adopt that. The FASB issued accounting standards update for pension plans. It did enhance add a few new disclosures for defined benefit plans. The interest crediting rates for cash balance plans and other plans with a promised interest crediting rate will have to be reported. Also, a statement explaining the reasons for significant gains and losses pertaining to the benefit obligation over the measurement period will have to be reported. There were also some other streamlining features in the guidance, and so certainly we all ought to be aware of those, and our accountants ought to be aware of those updates. Finally, we have updated PBGC forms, and so this follows guidance from the PBGC calling into question certain transactions that were designed to significantly reduce PBGC premium obligations. And so effectively, certain employers were taking advantage of exceptions to the PBGC premiums. So what they were doing is they were establishing a spin-off plan that took most of the employees that were, or most of the participants in the DB plan late in the year, and then retaining in the old plan just a few participants, and then immediately terminating that plan. And so the exceptions provide that there's an exception to the variable rate premiums in the year of termination, and then also in the new plan, there's also a rule for proration of PBGC premiums for a short plan year. And so employers were taking advantage of this. The PBGC has concerns about this, that it's elevating form over substance, and that we're largely avoiding significant PBGC premiums while the vast majority of the participants are still participating in the plan and still a risk to the PBGC fund. So be aware that there have been updated forms. There's updates in the instructions and examples of these sorts of transactions, and I would be wary about engaging in this sort of transaction without carefully evaluating it. 401k plan hot topics. Another recent development on the 401k side is a recent private letter ruling just last month addressing non-elective contributions tied to student loan repayments. And so, as we all know, a lot of our younger employees have been saddled with large student loans, and it seems to be an escalating issue year after year after year. And so employers are looking for creative solutions to that, to assist their employees with loan repayments. And this is really an interesting structure that was proposed in this private letter ruling. The employer proposed, well, let's back up. The plan in question had elective deferrals, could make it on either a pre-tax or Roth basis. Also had matching contributions. If an employee contributed deferred 2% of their compensation, the plan would match 5% of the compensation to the plan. They proposed to add a 5% non-elective contribution for participants who commit at least 2% of their compensation to repay student loans. And this is done on a payroll by payroll basis. So each payroll, there would be an examination of whether they did use at least 2% of their compensation to repay student loans. And if so, at the end of the year, they would calculate their non-elective contribution. For participants that are eligible for the non-elective contribution, they're not eligible for the matching contribution available in the plan. There was also what they considered to be a true-up matching contribution in the plan. So let's say, for instance, somebody decided to take the path of repaying student loans at a 2% clip at least. They received the 5% non-elective contribution for certain payrolls, but then stopped sometime during the year. If they did that and they also made deferrals to the plan that were sufficient enough to receive matching, there would be a true-up matching contribution made at the end of the plan year. And there was some concern that this structure would violate the contingent benefit rule. And so let's just talk a little bit about what the contingent benefit rule means. So a qualified COTA will not be qualified if any other benefit is conditioned on an employee electing to have the employer make or not make contributions in lieu of receiving cash. So one notable exception is matching contributions, because that's specifically tied to whether somebody makes a deferral. But so, for instance, we couldn't condition somebody receiving life insurance coverage on whether they decided to make contributions to a plan or not. And so the IRS very, very briefly and concisely said, no, we examined this structure and we don't believe that this violates the contingent benefit rule, because the payments are not conditioned on an employee making or not making contributions to the plan. And so the contingent benefit rule is not implicated. So I would issue a strong word of caution, though. The private letter ruling only provides guidance to the particular taxpayer to which it was directed. And so other employers can't necessarily rely on this private letter ruling for their own plans. Also, it very clearly indicates that the IRS did not consider other qualification requirements for qualified plans in their analysis. And so certainly this sort of design, or a design like this, could have other implications, other qualification implications, including non-discrimination testing. And then as a practical issue, you need to think through how you would track this and apply this. I think it could be quite cumbersome to try to track what employees are paying to repay their student loans over time, and with this feature of coming in and out of the non-elective contribution and potentially otherwise into matching contributions. So I would not take this lightly. I would not adopt this in a knee-jerk fashion. I would certainly consult with counsel and make sure that you're considering all the implications of taking this step. Another hot topic for 401k plans are hardship distributions. So there have been a number of revisions. One, with the Jobs Act last year, there was a revision of the casualty deduction definition. So it's limited to presidentially declared disasters, which indirectly modifies the safe harbor hardship rules. Remember, if we step back, hardship distributions are permitted under the 401k regulations if certain requirements are met. One, they have to be on account of an immediate and heavy financial need of the employee, and it has to be necessary to satisfy that financial need. And there are certain areas where we have deemed hardships, right? Deemed immediate and heavy financial needs. It's the list that we typically see in our plans very often in the pre-approved plans, or maybe universally in the pre-approved plans. They rely on these safe harbor reasons or rationales for an immediate and heavy financial need. And one of those is tied to the casualty deduction definition. And so while there may not be a need for a plan amendment, you do have to recognize in operation that this could change how hardships operate for that purpose anyhow. For 2019, the Budget Act that was adopted earlier this year made other changes to the hardship distribution rules. So it expanded the sources that are available for hardship distribution to include QNEX, QMAX, and then earnings on QNEX, QMAX, and deferrals, which is a significant change. It eliminated or provided that the 6-month suspension on deferrals following a distribution is no longer required. And it also eliminated the obligation to exhaust plan loans before taking a hardship distribution. And so one of the concerns that we have is the IRS has not issued guidance yet on these changes. So if we make some, but not all of these changes, can we still fall within the safe harbors of the hardship distribution rules? And so there is some concern on the part of employers as to what direction should be taken. I know that a number of the record keepers and plan providers have gone ahead and made some decisions as to how they will operate their plans or what amendments will be made to their underlying plan terms, but certainly ought to be aware of the changes and consider the different options that are available.
Ed, I think in the interest of time, I'm going to suggest that we not discuss the slides that were included around the litigation, only because I know we're covering that topic and we have just a few minutes left, and I want to also do a housekeeping item or two at the end. So if you want to skip to the very last slide, the don't forgets.
Yep, absolutely, Laura. No, and that's a good point. We do have another presentation next Thursday that will cover in depth the last three slides that we just skipped over, last 3 or 4 slides that we skipped over. So, please take a look at those slides, but understand that if you're able to attend next week, that'll be a much deeper dive into that. And so we end with and don't forget. So remember, we had the final disability claims and appeals regulations that were effective for disability determinations after, I believe, April 1st of this year. So if there are any housekeeping items to do or addressing the disability claims and appeals regs, it's wise to take a look at that and make sure that we've dotted our I's and crossed our T's. Adoption of any discretionary amendments. Remember, we do have some disaster relief from 2017 that may require future amendments, so be aware of those issues. Year-end notices. Time marches on. We have our year-end notices coming up. If we have a QDIA, we have QDIA notice requirements. If we have a safe harbor plan, we have safe harbor notice requirements. We also have auto-enrollment requirements and escalation requirements that may be necessary. Also check on the last time that you made your annual participant fee disclosure, because remember, we do have guidance that gives a little bit of play in the time frame in which we have to deliver that. I think it's a 14-month window after the last notice. So double check your records if you haven't done so yet. Forfeitures may be used to fund QNEX and QMAX. This was the subject of proposed guidance, which was largely adopted in the form of the proposed regulations. So we can now use forfeitures to fund QNEX and QMAX, including safe harbor contributions. Remember to check your plan, because while it's permitted under law, your plan terms may restrict that. Certainly check with your pre-approved plan provider if you're using a pre-approved plan, because they may have adopted an amendment to address this before. Finally, review trust documents and service agreements regarding data privacy and security. This is another hot button item that's come up. We see this every day with breaches of information, and so we need to button down this aspect of our practice and compliance. Laura, do you have any other items you would like to address?
No, I think that covers it. Just 1 or 2 quick housekeeping items before we end here. If you would like CLE or HRCI credit for this 1-hour presentation, there is an attachment on the upper right-hand side of your screen, just above where where the question button appears. You need to print that form, complete it, and return it according to the instructions. You will need a code on that form, and that code is TH920. T is in Tom, H is in Harry, 920 is the code to insert on the CLE or HRCI credit form, which again is an attachment in your upper right-hand screen. I just want to thank everyone again for attending the webinar today and remind everyone to take just a minute or two to complete the evaluation that will be emailed to to you immediately following this presentation.